Right, good morning, ladies and gentlemen. Good to be back on Boutiques on Wednesdays with you all again. And thank you all for joining, and thank you for seeing so many of you at our roadshows the past 3 weeks. Trade wars are firming, and it will have a knock-on effect on global growth and supply chains. And for the greater world economy, Trump trade wars spells chaos. China's response this far has been tame, but they did say if this is a path ahead and continuing this way, they will respond in kind and taking or suing the US at the World Trade Organization. Both Canada and Mexico are fighting back and turning this into a tit-for-tat trade war, and stock markets are definitely feeling it. On the other side, US bond yields are also on the uptick again, and the same with SA bond yields, also on the rise. This and more when we focus on SA fixed income and SA equity this morning and the impact of all these events and where we are heading. It's my pleasure to welcome our guest presenters for the morning. Raphael Ndem, Chief Investment Officer at Taquanta Asset Management, speaking to things like portable alpha on bonds and what that is all about, as well as Catherine Blash from investment or investment analyst at Granate Asset Management, speaking to how selling a share when the PE is high is not necessarily a good thing, and should we jump off the train or not? Sounds very interesting indeed. Good morning, Raphael. Good morning, Catherine. Great to have you both joining us this morning. How are you doing?
Good morning, Eugene. I'm doing good and very proud to be invited here to present to your platform.
Fantastic. Raphael, you're up first. Catherine, you're going to follow Raphael. Raphael, we need to keep to the time as quickly as possible because we are going to take some questions from the audience after both presentations. But you're welcome to start if you're ready. Thank you so much.
Thank you, Eugene, and thank you to my co-presenter, Catherine. I represent Taquanta Investment Managers. We're mid-sized investment manager based in Cape Town with about 275 billion in assets under management. The presentation today will be just a strategy that we use to manage equities and bonds. Although I'm going to focus on bonds, but this strategy is very much applicable to all asset classes, provided that there is a derivative market. I put some disclosures here, and then please pay attention to number 3. Past performance is not necessarily a guide to future performance. Let me jump into it. The problem I'm trying to address today is that of an advisor who has an asset allocation, who has made an asset allocation decision to allocate to equities, bonds, inflation bonds, cash, and so on. And I am going to focus on the carve-out of the bond allocation and assume that the advisor is looking for a specific bond manager who can deliver above benchmark returns. So in general, when you're faced with such a problem, the typical investment strategy is to find a suitable active manager who can take positions along the yield curve, and betting on certain inflation trends and interest rates. And that once you allocate like that, you just don't know what's going to happen next. The market might go up or down, or your specific choice of bond might not perform as well as the market is performing. Now, the problem, we thought about this problem quite deeply and for many years now, is to say, at the end of the day, for most investors or asset allocators, for most of the day, at the end of the day, they want to outperform the benchmark, irrespective of what the market does. And is there such a strategy that can at least give me confidence that a year from now, if the whole bond index is up, let's say 20%, that I'm going to generate, call it 21%, And if the market is down, call it 10%, that I'm probably going to be down 9%. So is there such a strategy where I will outperform the market irrespective of the direction of the market? It turns out that, yes, it is possible. And I'm going to try to show today how we actually do it in practice. Now, before I go on to show how we manage a bond portfolio at Taquanta, I wanted to show this graph in front of you, which is the percentage of underperforming active South African funds. And this is across equities, bonds, and cash or short-term bonds. As you can see on the chart on the far left, this is equity managers, and this is the percentage of managers who underperformed the benchmark over, let's say, last year, last 3 years, 5 years, and 10 years. As you can see, over a 1 year period, there were about, according to this research, there were about 65% of managers who underperformed the benchmark over 1 year. And over 5 years, that number was in excess of 80%. And if you looked at 5 years, you had close to 95% of managers in South Africa in the equity, active equity managers underperformed the benchmark. Now, you might say the problem is just applicable to equities, but if you look at the far right bars, that is bonds managers. So although bond managers tend to do a little bit better than equity managers, but if you look at the 10-year performance, there's almost close to 80% of managers cannot beat the benchmark. Now, the problem is not just applicable to South Africa. If you look at the global benchmark, if you look at global equities, the same trend applies. So the story here is that it's extremely difficult to outperform benchmark and to outperform benchmark on a consistent basis. Now, there is a caveat here, is that if you look at where short-term bond managers, which are essentially cash managers, they tend to do much better than the benchmark. But that is only for cash managers. So we thought about this problem and said, is there a way to combine the cash skill sets and call it the passive or the beta skill set that you get from the indices in a way that can generate performance irrespective of what the market does? And this chart, the fact that managers can outperform the benchmark has led a lot of our investors to start to look at passive investing. Passive investing has a lot of merit to it. It's very cost efficient. It removes a lot of the risk of specific stock selection risk. It relies on a broader market wisdom. You just get in the market return, whatever that market return is, and so on and so forth. So there are a lot of merit why in the US, for example, 50% of allocators today are invested in passive. And what I mean passive is trackers and ETFs and so on. And it's just because it's a lot simpler and at least guarantees you performance that are very close to what the benchmark will give you. The problem with passive is what we show on the right-hand side is that passive, after costs, if I just mean costs, gross investment, let's say brokerage costs, GSC levies and fees, SCTs on buys only, net investment amount, and so on. So if I look at all of these costs, if you put in 100 million rand, at the end of the day, only about 99.7 million will be invested because 31 basis point of your total investment will go into paying fees. And that is before you pay the management fee in this account. So if you invest in a strategy where 31 basis point is already just transaction cost, you are going to get benchmark or near benchmark returns, but those returns are going to be below what your benchmark actually gives you. So this doesn't seem to us like a very wise investment decision. Now, we thought about this problem and we say to ourselves, it's probably better to consider this problem as a structuring problem. And when I mean structuring, I'm probably going to explain shortly what structuring means. And to give you an example, let's say this is the client. You invest, and before I actually explain this graph, let me drift a little bit and then show you where this graph will come from. Let's say for a typical, let's say you want to buy, you're looking for a house, and the typical investor in the housing market is probably a person who would not use all of his asset to buy a house upfront cash. And this is why. Let's say you find a house that is worth R1 million, and then you decide that you like the house, and then you want to approach your local bank to help you fund that house. Now, let's say you have a house is worth R1 million, and then you have R1 million in your account. Now, the one easy decision for you to make is to take your R1 million and then buy the house. Of course, that is not what most people do. Most people will go to the local branch and find a bank manager and say, I want to buy a house. I found a house in my neighborhood. It's worth about R1 million. Would you help me buy that house? The bank might even know that you have R1 million in your account, but never the bank will ask you to take the R1 million and put it down to buy your own house. Typically, what the bank will do, the bank will ask you to put a deposit of, call it 10%, and the bank will fund the balance on the house. Okay, why is that we do that? We do that because this is the most efficient way of purchasing a house. Even though we have the savings to purchase a house, no one actually uses the entire savings account to buy the house, because we always have to provide for a bit more liquidity after we purchase a house. So if you think about that problem and then say, okay, once I purchase the house, essentially I created an asset and liability problem. On the one hand, I have the house and I still have 900,000 Rand in my bank account. On the other hand, I owe the bank 900,000. So net, I have an asset and a liability. If you look at that, that gives you a position where your books are probably balanced, provided that your 900,000 in your bank account does not underperform the cost of servicing the house. What I mean by that is, let's say the bank charges you 10% interest or mortgage rate on the house, and that your 900,000 in a bank account can give you exactly 10% return. At the end of the day, you will earn 10% return on your account, but you pass all of the 10% to the bank. And that decision is very equivalent to just having the house upfront with your entire cash balance. Now, if you are a little bit clever and then you take a bit more risk and invest your 900,000 in call it an interest-bearing account that gives you 12%, and then you owe the bank 10%, essentially you earn 12%, and then use 10% to pay the bank, and then you're left with 2% on 900,000 Rand. So that 2% will add on top of the house. So at the end of the day, you will get your house plus an interest of 2% accrued over the life of the loan. So that is in essence what Portable Alpha does, but we take different terms and we explain that differently given the mechanics in that structure. So if I go into this chart now to explain what is actually happening, the client will invest, let's say 500 million in a local or foreign asset class. Let's say it could be bonds or it could be equities, doesn't really matter. It could be domestic bonds, could be domestic equities or foreign bonds. Now, we will enter into 2 transactions at the same time on day 1. And the first transaction will go to a bank, exactly like you will do with a mortgage account, and then enter into a contract. In the mortgage case, you will say it's a mortgage loan. In the kind of this type of investment, we call it, let's say, a total return swap or a futures. So we'll get into a contract. It's just a contract between ourselves and the bank. We don't give the bank, there's no exchange of cash flow of cash on day 1. So the bank doesn't own you or doesn't hold your 500 million. The 500 million is still at Taquanta, but we get into a contract where we agree with the bank that the bank will pay us a total return on the reference index, let's say the old bond index, and then we'll pay the bank, let's say JABA plus 75 basis points. So this will then be a closed transaction, but we need to find how we're going to get the JABA plus 75 basis points to pay to the bank. To do so, we will deploy the 500,000. We deploy the 500 million, in what we call a cash collateral account with a mandate to never underperform the JABA plus 75. It turns out that currently a cash collateral account, which can be called, think of it as an enhanced money market or an enhanced cash portfolio, once we get into that account, currently most of those funds are giving in excess of JABA plus 200. In the case of the cash collateral account at Taquanta, we're earning about JABA plus 275. So if we earn 275 in the cash collateral account, JABA plus 75 will go to the bank, and then we'll have an excess of 200 basis points in the cash collateral account, which will be added on top of the reference benchmark, which is the OB. So net the client will get the reference index plus 200 basis point gross of fees. So this strategy, as you can see, does not depend on what the market does. Irrespective of where the market goes, the bank will still pay us the reference index, and we will still pay the bank JABA plus 75. This is an agreed contract, which will last the term of the agreement. If the agreement is for 3 months, we will do that for 3 months. If the terms is for 1 year, we will do that for 1 year. It doesn't matter what happens to the bond market. So essentially the alpha, the excess return that is generated in this type of strategies comes from your cash collateral account, doesn't come from what the volatility in the reference index are. So that's in a nutshell what people call portable alpha. Is as simple as that, although implementation can take a lot of tweaks and terms quite involved as implementation. So you might ask yourself, what type of risks are you exposed to in a cash collateral account? Remember that you have 2 different portfolios. You have what we call the beta portfolio, which is just a reference index returns. And then you have the alpha portfolio, which is in this case an enhanced cash portfolio. So you have risks on the 2 portfolios. Now, what type of risks would you typically see in the reference benchmark portfolio? The good news is that not much. You don't have any active bets, you don't have duration, you don't have convexity, you don't have any active sector exposure, you don't have any yield curve exposure, you don't have any term premium exposure, etc., etc. So it's just you holding a portfolio that looks exactly like the benchmark. That's all you want. And that portfolio is cheap. You don't have to pay for that today. You don't use your cash to pay for that portfolio. Now, on the cash collateral account, it's going to be the typical risk that you have in an enhanced cash portfolio, enhanced money market portfolio. It's going to be a little bit of bank risk, but typically most funds will hold the 4 largest banks plus government bonds. So you don't have, most of these funds will reprice at once, so you don't have price volatility. You might have sometimes a little bit of credit risk, but generally it's very small in this kind of portfolio, et cetera, et cetera. So as you can see, this is a very low risk kind of enhanced strategy. You have the reference benchmark on the one hand, and then you have the cash collateral account return on the other hand. So it's a very efficient portfolio that will deliver performance irrespective of where the benchmark goes. Now, for the rest of the time, I wanted to show a couple of graphs in terms of how that portfolio has performed. This is, for example, what we do on the equity. This is the cap sweeps. I just wanted to show the cap sweeps as well as the bond, because it's really this strategy performs irrespective of what benchmark you choose. As you can see, the fund has done about 200 basis points above the cap sweeps since inception, and that is irrespective of whether interest rate went up or interest rate went down. Is irrespective of where the equity market went up or the equity market went down. So it really doesn't matter. And then you can see the performance over time on the cap sweeps. What I wanted to show is also important here is to look at what the performance has been relative to most active managers in the country. Now, I'm showing this because this is available information from Alexander Forbes. This is the Alexander Forbes Large Managers Watch. It's a little bit different from, let's say, what you get on Morningstar, which is more retail, unit trust kind of database. This is an institutional database, and it's most of the largest managers in the country. So if you look at the equity, if you take the 2% line, by the way, the horizontal line is your tracking error. On a vertical line, you have the excess return alpha per year. So if you look at the horizontal and say 2%, you can see that very few managers in the country have been able to give you 2% active returns. And they do so, not only they can't give that sort of active returns, but they also take an excessive amount of active risk to generate that. So there are a few managers who have been able to do in excess of 2% alpha, but they have to do so by taking a significant amount of risk, risk defined as excess volatility above that of the benchmark. Now, if you just look at the passive managers, this strategy does significantly better than the passive managers with pretty much the same level of risk, which is what you would expect from a portable alpha strategy. Now, on the bonds, it's exactly the same kind of performance. If you look at the alpha on the bond strategy, it gives you about 200 basis points. If you look at the performance over time, it's also been growing up nicely. If you compare that to all the bond managers, it's exactly the same story you saw with equity managers. On average, managers give you return that is not that is below what you get from a portable alpha manager, and they do so by taking more risks. And those managers who tend to do better than portable alpha manager strategies do so by taking a more active risk in the investment strategy. Now, I'm just going to leave it there for now. Just suffice to say, portable alpha does work. It does resolve a problem for a client who simply wants to get benchmark return plus an excess return. It does not resolve the issue of having aggressive bets around, let's say, the benchmark. Portable alpha typically won't give you an aggressive excess return of 300 basis points or 400 basis points, but is also most likely not going to deliver negative return for at least for a prolonged period of time. In fact, since inception, we've never had a year-on-year loss, a negative active return in this type of strategies, and it's probably a strategy that is worth putting in your toolkit. Thank you.
Well, very interesting indeed. Thank you so much for that. We are going to take questions a little bit later, but I want to get Catherine on board with their presentation. If you can maybe stop sharing. Yeah, that's gone. Catherine is standing by from Granate Asset Management. Catherine, again, thank you so much for joining us this morning. And it was good to see you at the roadshows as well.
Thanks. Are we all good there?
Fantastic. Perfect. Thank you. Okay.
So as Eugene said in his introduction, it certainly feels like the world is very topsy-turvy at the moment. If you're anything like me, when you open the news, it seems like the world is very uncertain. And that makes it difficult to try and figure out where things are going to go and what's going to happen, what decisions might be made by politicians, and then what the impacts of those might be. So at Granate, we try rather not to spend too much time focusing on making narrow predictions or bets about what might happen. Instead, we look for those timeless truths that we think can apply even in turbulent times. And that's what I'm going to talk to you about today, just one of those truths. So if you have a look at the slide, and you can maybe think for yourselves, what do you think these guys have in common? So other than some obvious kind of demographic similarities, I hope that you're all saying to yourselves, they're very wealthy. Now, why are they very wealthy? They're all very wealthy because they have built businesses that have some form of competitive advantage on a very strong growth vector in the world that continued for a long time. So if you look at some of the examples there, Bill Gates, it was the rise of personal and enterprise software. Jeff Bezos, it was the move to online consumerism. John Malone, it was the rollout of cable TV in America, or Giovanni de Medici, it was the formalization of banking in Europe. So what this suggests is that the best way to build wealth is to find a strong growth vector in the world that has many decades to go and build a business that has a competitive advantage. So as investors, it seems like the best thing we could do is to look for businesses like that, right? And all we need to do is find them and buy them. But if that was the case, there would be a lot more rich people in the world, and they unfortunately aren't. And we think the reason for that is that investors fall into one of three traps. The first one is that most investors take profits way too early. And I'm sure most of you, like most of us, have made the mistake at some point of buying a stock. It goes up. You think, wow, I've made a profit. and you either reduce your position or sell it to take some of those profits off the table. But if it's a great business that ticks those first two boxes, it probably has a long way to grow, and you miss out on all of that future upside. It ends up that you're trimming the flowers, the businesses that have room to grow, and watering the weeds, the ones that look cheap but are probably cheap for a reason. The second trap, though, is that sometimes that first trap isn't actually true. So there are times in the market when prices become so detached from reality, especially in that kind of bubble territory where there's hype around a stock or around an area, and that can mean that buying at those prices can end up being a mistake. And the third one is that growth attracts competition. So the free markets are a brutal place. If a company is operating in an area that has exciting growth, it's going to attract capital. And that means that companies need to continuously reinvest to protect that competitive advantage. And as an investor, you can get things wrong if you're not aware of that. So I'm going to take you through a simple example of each of these traps. So what you can see on the slide here, the red line, is Capitec's price to earnings ratio, which, as you should know, is a metric that's often used by investors to decide whether a stock is cheap or expensive. And you can see that there's many points in Capitec's history where they were trading on a price to earnings ratio of 30 or above. And that's a point at which any sensible value investor would decide, whoa, this is expensive, and decide to reduce their position or take profits. But what the bubbles on the chart show you, the blue bubbles, is the total return that you would have earned as an investor if you had bought Capitec's shares at those points where the stock seemed expensive. So anywhere from in 2006, if you'd bought it then, you would have got 30% a year to in the big COVID crash. The big COVID chaos of post-2021, you would have earned 14% a year, all of which is a very nice outcome for an investor. So the moral of the story here is never sell Capitec. And in the context of our portfolio, we think Capitec still has a very long growth trajectory ahead of it, and that's why it's still one of our larger positions. But like I said, the second trap. Sometimes the first trap isn't true, and you actually do need to be aware of the price you're paying. So what you can see on this chart, the orange line is Microsoft's share price from 1992 to today. And the blue line is Microsoft's market cap to revenue or price to revenue multiple. It's similar to PE, but we're just now looking at it on the basis of revenue, not even profits. And you can see that in that period, 99 to 2000, Microsoft was trading at a price to revenue multiple of something like 25 times. Now that's completely insane. And what it implies is that people were projecting a future for this business in terms of its growth or future prospects that was completely unhinged from anything that could have possibly been a reality. So if you look at the orange line, if you'd bought Microsoft at that point, it would have taken you something like 15 years to make your money back. And that shows you need to be aware of the fair value of something. And that's why we would do a valuation. It doesn't get you to the exact right answer, but it at least makes sure that you're not exactly wrong. And then trap 3, growth attracts competition. So what you can see on the chart there is the total return of two stocks. The black one is BlackBerry and the gray line is Apple. And this is from 1997 to 2007. 2007 was the time when BlackBerry was absolutely killing it, and you can see it in the share price performance. That was when it was very cool to have a BlackBerry. Everyone from teenagers who wanted to message their friends on BBM to executives that wanted to look cool with their multiple BlackBerries. And you can see Apple was basically nowhere. But then what happened? In 2008, Apple launched the iPhone. And that absolutely slayed the competition. And as you know, today, pretty much all smartphones in the world are copies of the iPhone. So if you extend that chart onwards from 2007 to today, you can see that BlackBerry has all but disappeared and Apple has just gone from strength to strength. And that shows that it's incredibly important for a business not just to ride a growth wave, but to make sure that they're continually reinvesting to maintain their competitive advantage, whether that be through innovation or R&D. And as an investor, it's important to be really aware of whether they're doing that. So it's simple, right? We just need to look for companies that are operating in growth sectors that have a competitive advantage that they're continually working to reinforce, and avoiding those three traps. The problem is that companies like that aren't necessarily that easy to find, especially trading at a price that seems at least not too crazy. But fortunately, there is one other force that we can harness. So what you can see here are the share prices of two companies. Let's call them the hare and the tortoise. The hare is a business that managed to outperform the tortoise by a factor of 3.5 times in this period from 2002 to 2025. And we're looking at the total return here of the two stocks. One of them is a railway company, and one of them is a software company, and both are based in the US. Now, I'm sure you would assume that the top line is the software company, particularly considering that over this period in the US, rail volumes basically went sideways or had very little growth, whereas software had tremendous growth. But the truth is actually the opposite. The top line is the railway company Union Pacific, and the bottom line is the software company Microsoft. Now, this chart kind of cheats a little bit because we're starting in 2000, which I showed you before was the height of the dot-com bubble. So there's a price tailwind for Microsoft. So let's look at a slightly better chart, which is starting from 2002, which is after the end of the bubble. And what you can see here is that Union Pacific now is the red line there, and Microsoft's the blue line on the bottom. It took until basically 2023 or 2024 for you to have made the same amount of money in Microsoft as you would have made if you'd bought Union Pacific in 2002. So what happened here? How is it possible that a company in a no growth area managed to outperform a company in a high growth area for such a long time? And the reason for that is that competition reduced. So there were regulatory changes in the rail industry, which led to consolidation, and that meant reducing competition. The rail companies like Union Pacific were able to focus on the areas of the market where they were the cheapest form of transport, and then invest to improve their operations and improve the quality of the service that they were able to offer. And what that meant was that they were able to expand operating margins over this period from something like 10% to 40%, which is pretty crazy for a business that isn't a capital light software company. So what this shows is that you can do well, like you would have done out of Microsoft here. You can do well out of a company on a growth vector, but you can also do very well investing in something that isn't in a growth area, but where competition is reducing. So to end off, I'm just going to talk through one example in our portfolio that actually brings all of these areas together. And that's the company called TSMC, Taiwan Semiconductor Manufacturing Company. What TSMC does is that they manufacture the computer chips that are used in everything from smartphones to laptops, cars, washing machines, and obviously data centers that power everything from cloud computing to AI. What TSMC does is they're actually producing things that are at the scale of a fraction of a human hair. We're working in the size of nanometers. It's completely mind-bending. Firstly, they're operating in an area that has a really strong growth vector, and that's our need to process and compute data. What that means is that we're needing to squeeze computing capacity into ever smaller spaces. So if you look at the first chart here, it shows that with each successive node, and a node just means the next stage of technological advancement in chip manufacturing complexity is increasing rapidly. What that's meant over time is that with each node, fewer and fewer manufacturers have been able to keep up with that pace of technological development. And you can see on the chart there on the bottom that over recent years, or at least over the past decade or so, it's basically only been Samsung, Intel, and TSMC that have been able to manufacture chips at the leading edge of technology. And actually, at the moment, both Samsung and Intel have challenges and are leaning on TSMC to manufacture for them. What that reducing competition has meant is that TSMC has been able to grow their market share to something like 2/3 of outsourced the foundry market of outsourced semiconductor manufacturing. And that growth, not only being in a growth vector, but also being able to gain market share through reduced competition, has led to really quite stellar financial performance. So over the past 10 years, they've grown earnings at 27% a year, or 5 years, it's at 36% a year, which is incredible for a company that is really already very big. And they're able to operate at net margins of, over the past 5 years, the average margin of 40%, which is, again, what you would expect to see from a capital-light software company, not from a capital-intensive manufacturer. We think that growth vector, again, has a long way to go. It continues to trade at a very reasonable price, and that makes TSMC also one of the larger positions in our portfolio. So to conclude, there's room for both hares and tortoises in our portfolio, companies operating in growth areas or companies operating in areas that are just less contested parts of the free market. And if we think that if we can find those, our clients can do very well. And more importantly, if we can avoid those traps, so if we can hop on, we can remember to stay on, and we're continuously making sure that companies are reinvesting in their competitive advantage, then we think our clients can do very well. Thank you.
Catherine, thank you very much for that. I want to stay with you. I don't see any questions from the audience yet. But if we could maybe start, I mean, you've got a range of funds. You've also had a balanced fund. You've got a flexible fund. More specifically on the flexible fund, you've got a very daring benchmark of inflation +6. It's a straight line, and we know that markets don't move in straight lines always. You had a phenomenal year, 2024. I think you, if I've got it right, you finished on about 25%. But I think what a lot of investors want to know, especially with all this rhetoric going on in the world, I mean, I mentioned in the introduction as well, I mean, surely there's trade wars. We can see countries going into a tit for tat. It will disrupt supply chains again. It will have an impact on places like China. It will have an impact on places like SA, where the belly of our economy is still commodities. You've illustrated, obviously, that Granate are good stock pickers. But my question is, in a flexible fund, given what's happening in the world, how does that impact on your asset allocation views? Tough one.
So, yeah, it's a tough one. Typically, the way that we think about, typically the way that we think about asset allocation is we tend to not make big top-down calls. And it's unlikely that you'll see us making huge shifts in the portfolio quickly. We think of asset allocation more as looking for great opportunities, and then it tends to build up from the bottom, but obviously having to take into account what's going on in the world, and that's absolutely true. So at the moment, we're still seeing many great opportunities in companies like the ones we've mentioned today, and we love the companies we own in South Africa. They're doing very well. If we look at I don't know, something like Santam that reported yesterday, that's really going it's really looking great. So we're still finding many opportunities to invest in companies at reasonable prices that have competitive advantages and seem to be in a good space. But at the moment, there certainly is a lot of volatility. So we're trying to be flexible around that, and be able to take the opportunities to buy more of the things we like when prices fall. And that's kind of what's been happening in the semiconductor space that's had a bit of pain at the start of this year.
Do you think one needs to be far more selective in terms of which companies you invest in 2025 as opposed to 2024?
Oh, that's a good question. I don't think anything would change in terms of the way we think about it in our process. We're very qualitatively driven in how we pick stocks. So we try very hard to look for businesses that are run by good management teams, that are well governed, that are good capital allocators, that have very strong and resilient balance sheets, which I guess is very important in a more turbulent time. And also to look for businesses that can do well without having to make narrow predictions about where the future is going to go. So I think that all of that still very much applies. But obviously, it's always important to consider the risks, and there might be areas where risks are increasing at the moment.
And I mean, if Trump tweets, the world doesn't stop, the world goes on, and consumers still need to spend money on various things on those companies or in those companies with strong growth vectors, as you illustrated. Raphael, if I could maybe bring you into the conversation, specifically on your equity fund, your benchmark there, the SWIX over the rolling 3-year period. So it's a pure equity portfolio. And maybe if I can ask you, I just want to check, Raphael, you still on? Yeah?
Yes, I'm on. Yeah.
Fantastic. And again, SA equity did phenomenally well in 2024. We all know it. But if we perhaps in a world where you need to be more selective, I understand your alpha thesis and how it works and how you generate returns above the JSE. But what would you say to clients saying, but maybe this is not the time just to buy the whole market?
Yes, it's a very astute question. It's a difficult one. The problem with asset allocation or timing decisions is that the outcomes are really unknown and completely unpredictable. That's why you need a multi-asset class. That's why you need a balanced fund in the first place. So it's not always a question of, do I need the market? It should be a question of how much of the market do I need for a particular cycle, right? So you can have, and I think Catherine made the point that you can have, if you look back and look at where the valuations are and try to anticipate what's going to happen, sometimes it's not really correlated to any of that. And you can have a perfect foresight and know exactly that you're going to have interest rates not going to come down, and potentially people are going to start talking about interest rate in the US going up. You can have all of those things line up, but still the market doesn't respond the way you think it should be responding. So my central thesis is always to say, if you're concerned about equity, you dial down a little bit. If you're bullish on equity, you dial up, but not, should I get into equities now or not? That is very risky as a whole. So if I look at the market, I think there are reasons why equities, and that's why I agree with your views, is that 2-3 years ago, equities was the only play in town. There was no yield. And if you look at, I think at the time they said there is no alternative, the TINA kind of argument. Today, yields is abundant. I mean, yields are very high. Even in the US, you can get 8% in money market accounts. In South Africa, government bonds are offering you like 11 or 12, 11%. So if you look at that, it doesn't take much in South Africa to get a 15% return on bonds. You don't need a lot. You need one yield to rally by, call it 30 or 40 basis points for the year, and then you get like a 15% return. So the hurdle to equity is significantly higher than it used to be because you have a lot of alternatives. So it begs the question of, should I actually invest in equity or not? And I think my view is that although I think bonds are offering a lot of value, I think it's very risky not to be in equities, because if you miss the rally, it can take you a very long time to catch up.
I tend to agree that, I mean, SA equity in general still good valuations if you compare it to the rest of the world, especially that of the US. And I mean, a lot of our audience members are constructing portfolios with building blocks. So if you are looking for a low cost solution, giving you alpha on the index, it's exactly what to look for. It's the Taquanta equity fund. Maybe just quickly on the bond fund, you touched on the bond fund very briefly. A similar thesis in terms of how you manage the bond fund, but maybe just for a simple understanding. I mean, and I've mentioned in the introduction as well, US bond yields still on the rise. SA bond yields still ticking up as well. You're giving alpha on the all bond index. And if you look at your historic performance as well, it's exactly what you deliver on. You know, so if clients are in favor of bonds, they still believe that SA bonds are going to give you fairly good returns for 2025, regardless of how you build it into portfolios. Also, definitely a solution worth looking at because you get that alpha. But maybe just quickly your views on bond yields at the moment. Where are we going? Because I mean, in simple terms, trade wars equals inflation.
Yeah.
Inflation going up equals bond yields going up. Your views on that, just very quickly.
Yes, you're absolutely right. I think the world has changed in November with the new Trump administration. It's going to change for the next 4 years at the very least. And as you point out, if you go into trade wars and tariffs, if you have mass deportations in the US and so on, all of that is inflationary. That the result of that will be some inflation. So at the very least, in my views, is that the historical kind of neutral interest rate, which was, I think the Fed was targeting 2% inflation. And they actually had a long period of time where inflation was way below that. I think going forward, inflation is likely to be a little bit more than 2% in the US, which means that globally, including South Africa, we're likely to see interest rate higher than it traditionally should have been or could have been, right? So traditionally in the US, the neutral rate of interest rates, or what they call the R-star, was around the 2%. Now the consensus, even among the Fed official, is that R-star is probably around 2.5% to 3%. Now, if you say 2 or 3% R-star, if you look at then the 10-year bond, you need to factor in a risk premium in the US. So if you construct that way, then a 5% 10-year bond in the US is not unusual. And probably the world will come to term that bond yields are not going to come back in the US to the 2% that people expect. Yeah. Which means the same thing in South Africa, by the way, which means that everyone is looking at bond yield in South Africa and say, sure, it's 11%, 11.5%. If you have a rally, you could make big returns. It might not get there, but at least you have the coupons. If you look at the yield to maturity, which is kind of where you will issue bonds at par, even if bonds don't move that much, in South Africa, you're still going to have 11%. So if you look at 10-year, and this is where I think long-term investing makes sense, is that if you look at a 10-year view and then say, okay, bonds with 11.5% yield to maturity now, for 10 years, you're going to earn 11% on South African bonds. So you need government to default to have a catastrophic event on South African bonds. So if you take a long-term view, you're going to earn 11%. Okay, cash will probably give you around 8% because cash will be higher than historically what we would have had. So which makes the hurdle, that's the thesis I made, the view I had earlier, that makes the hurdle for equity over the next 10 years quite high. So you need equities to give you what, 13%, 14% compound for 10 years. That is quite demanding, even if you say, okay, our equity is cheap and so on. But the problem with equities is that 14% compound can happen in 1 year or two. And if you miss those 2 years, you're probably doomed for the next 10 years because you're never going to catch up. So you remain invested. That's my view. I think I would probably say bonds offer you better value on a risk-adjusted basis. Even if bond were to go up, you can simply ignore that is noise. If you take a long-term view, you're going to accrue roughly at the yield to maturity today. So you're going to have 11.5%. And that is very, very good return. If you say inflation in South Africa over the next 10 years will be around 4.5%, bonds, that is about inflation plus 6, with very little risk and some amount of liquidity because those are government bonds. So I still see a compelling case for government bonds. I still see some case for cash, but I think it's going to be very difficult for equities to give you 14% to justify the risk return basis. But you cannot get out of equities because that can happen in 1 or 2 years. And if you miss those 2 years, it's a problem.
And I mean, plus alpha that you give clients on the bonds as well. But I mean, higher bond yields for longer is not necessarily a bad thing because you must think about the reinvestment, that's cash flows where that's going to. And I mean, if you're sitting on high yields for longer, you're reinvesting all the time
At the
with
high
high
yield.
yield. Your reinvestment risk is actually decreasing significantly. So it's
Yeah.
almost a perfect world.
If bond were to sell off, yes, you will get a capital loss. Let's say bond move from 11.5 to 12.5. You get a capital times the duration, so you get about 7% capital loss. But then your prospective return thereafter is 12% or 12.5. So it's even better. So you want to stay invested. I think long-term investing makes sense in my views. And for those reasons, because if you try to tweak too much and then you miss out, it will be very costly. It's very difficult to catch up after that.
Very true. Catherine, I mean, given what Raphael said, bond yields, if you look at bond yields where they are now, if you look at inflation where it is, even if inflation ticks up by another 1% in SA, I don't know where it's going to go. But then in a flexible fund for clients that are less sensitive to the market average or the peer group and all that kind of stuff. And so, but I like the story about your benchmark being inflation plus 6. Why not then just go for more bonds the next 12 months?
Yeah,
That's what people want to know. Yeah.
We do have a reasonable size bond position in both the balanced and the flexible fund.
Yes.
And it's for that reason. They have for a long time, bonds have looked very compelling, but we're always weighing up that versus the opportunities that are available. And if we didn't see opportunities in stocks that we think can do much better than that, especially when you factor in growth, we would be all in bonds. But especially when you look in the South African markets, look at something like the banks. I think, what is Nedbank on, like a 7% dividend yield or something like that? Yeah. With the potential to grow at least at inflation, or at least at nominal GDP, and I think they target nominal GDP plus 5%. So if you add that on top of a 7% dividend yield, you can do very well out of a stock like Nedbank. And so we just think the risk reward still looks compelling in a lot of equity opportunities, and that's how we would always be weighing the two against each other. But that's not to say that there's not a place for bonds in the fund. There certainly is. And bonds certainly we would certainly hold bonds over cash.
And I think it speaks a lot to your investment process as well, because the way you work, you don't start with that strategic asset allocation. You're saying, the one asset class relative to the other asset class, where we go. And,
and also the way we operate is we've got one investment team that has we don't carve out fixed income and equities as separate things.
Yeah.
One investment team, and that means we sit in our investment committee, and there's always a debate between the bond guy and the person who wants to sell bonds to buy equities. We have very lively debates around whether that's a good idea. So we're always making sure that the opportunities are boxing for their place in the portfolio.
I'd love to be a fly on that wall one day. It can prove to be very, very interesting, especially in the times we're in at the moment. I'm being very, very naughty with time. I know I'm stretching this out a bit. Very quick question from the audience, Catherine, and it speaks to the way you select companies. Are you saying it is good to invest in companies with less competition or companies who show higher competitive advantage than peers?
I think I was saying both. So what we look for is companies with a strong competitive advantage, but even in areas where you don't have growth, if you're often in those kind of spaces in a less exciting area, you end up with consolidation and reducing competition, and that can make things very good for the winner. If you think of how well ShopRite's done over the last 10 years in a sort of lower growth environment in South Africa, they've been very good executors in an environment where their competition hasn't. So you can see how those kinds of businesses can go from strength to strength when competitors start to slip up. That's just one example, but I hope that answers it.
Catherine, I'm going to pause here, Raphael. I'm going to pause it here. Unfortunately, the clock caught up with us. We can take this conversation for another 2 hours. It's a lot of things to unpack here, but I think you hit the nail on the head, Catherine, how you look at asset allocation within Granate, your balanced and flexible fund. Very insightful indeed, and how you find those companies with growth vectors or growth in earnings. I mean, it's very important. Like I said, doesn't matter what Trump tweet, the rest of the world is still going on. And Raphael, thank you very much. Very interesting strategies. And for the audience out there, how we work, open door policy. If you need to understand the Taquanta strategy a little bit better, get hold of us or Raphael and his team. And I'm sure they're more than willing to discuss it further. But again, that portable alpha strategy, if you are using a building block approach, want to get more exposure to equity or bonds, I think very useful strategies. And your TRCs on both obviously very, very attractive because of the nature of your funds. So it helps to reduce costs as well. Catherine and Raphael, thank you again so much for being on the session today. Always great to have you. And again, thank you for your participation in the roadshows as well. It's been really great. And we're hoping to speak a lot more to the both of you in the very near future. Thank you so much.